How does maintaining this £100 QT envelope influence gilt yields, market liquidity, equities, MPC policy moving forward? Put it all together for me.
Well, lots of moving parts, Dan, but certainly here's where we thought things could get a little bit more exciting, but they didn't. The MPC decided to take the path of least resistance, sticking to that £100 billion QT envelope, which was where consensus was. We thought there was a chance they could pick up that pace of active sales, especially given that £87 billion number when it comes to redemptions rolling off the bank's balance sheet automatically over the next 12 months. But look, this MPC just has pretty much told us that they're putting more weight on the stock reduction of the APF. And that's the key takeaway. The impact should be marginal. We're talking about active sales moving from £50 billion in the gilt market over the last 12 months to something more menial, £13 billion. But £1 billion of auctions that the bank will run over the course of every month over the next 12 months. So a much smaller footprint in the market. It should certainly have a very different impact of the last 12 months, and certainly one that will be less of a footprint that we've seen in the last year or so.
And Sanjay, when it comes to the overall rates outlook, as we assess the overall impact of QT and what happens next in that space, where do you see rates moving ultimately through 2025, and how aggressive will the easing cycle be, if at all?
So we're still expecting a gradual unwind or dial down of restrictive policy. We haven't changed that view for some time. And yesterday's message, I think, allows us to stick to that tone, stick to that message. We're expecting 4 quarter-point rate cuts next year. So ultimately, we see bank rate getting to something just south of 4%. Ultimately, however, Dan, we're expecting bank rate to get to 3% by mid-2026. And I think there are a couple of risks to this. One is that maybe the Bank of England starts to pick up the pace of rate cuts over the course of the next 6, maybe 9 months. And that's certainly what we're kind of seeing across the globe. Maybe there will be more evidence, more downside news on inflation. Pace settlements may start to converge back to that target consistent level. And that could give the MPC a bit more confidence to dial down restrictive policy a little bit faster than what our forecasts imply. However, there is another risk here, and that risk is certainly that runway for rate cuts may certainly end up being shorter than we expected, i.e., as economists call it, that neutral rate estimate that we're all trying to find, that we're all trying to solve for, may end up being slightly higher than the 3% number that we've outlined. So 2 risks. One, we could go a little bit faster over the next 6 months, but ultimately that runway for rate cuts may end up being a bit shorter than we expect.